Okay, well, there is a look at the story of the TSX, which has had a very respectable year. And one of the big storylines, obviously, is gold. Record gains in bullion have helped a lot of the gold mining players in Toronto. The love affair with tech in the U.S. has also influenced the TSX for the year overall. This week, it's interesting to see some fresh attention for industrials, which as a group have lagged the broader TSX story, but with all this nation-building talk are starting to get some attention. So can the TSX, at a time when there's uncertainty around the Canadian economy, continue this record run? Let's ask Denis Taillefer. He's a portfolio manager at Caldwell Investment Management. Denis, nice to have you with us. What do you think? Record run for the TSX, can it continue?
Thanks for having me, John. Yeah, we think it can continue. If you look at some of the underlying drivers that have really been driving the markets over the last year to date, 12 months, you're looking at still a fairly healthy earnings growth backdrop. We've had, especially on the U.S. side, a lot of infrastructure spending. We're going to start seeing that in Canada. And we've seen an easing of financial conditions. So those kind of three, I think, main drivers have really put on that risk-on type appetite. I think these are still in place going into next year. Valuations are a little bit stretched, so we still want to be mindful of that. But we think the backdrop is still somewhat constructive for the markets here going forward.
Interesting. And I mean, how would you compare sort of, because the makeup of the TSX is so different than, say, the S&P 500, what are the catalysts, do you think, to that sort of continued gain? And are they different catalysts, do you think, than, what people are going to be asking about U.S. stocks?
Well, they will be somewhat different. When you look at the performance of the U.S. market, and everyone's been speaking of how concentrated it's been in that Mag 7, in that artificial intelligence theme. The Canadian market doesn't have really the same exposure. Close to 50% of the U.S. market is really on the technology side. So it's been a very different types of drivers. But when you look at the Canadian market, we've had a certain amount of concentration here as well. We only have two sectors out of 11 that have outperformed the overall market. The main one being the materials, and you've spoken to that. Golds have been a major performer this year. In fact, if you look at the top 50 names on the Canadian market year to date, performance-wise, 41 of those are materials, and they're mainly gold and silver names. So we've had a certain amount of concentration. The other sector that's outperformed the market is technology, and there's really only two names that have really outperformed and done very well, and that's Shopify and Celestica. And Celestica is really a play on that AI, artificial intelligence spend. So as well, we've had a certain amount of concentration here, but we do think the outlook going forward is probably improving for some of the other sectors. We've seen discretionary and financials starting to do a lot better. So we do see that interest rate sensitive, those interest rate sensitive sectors improving. And we do think the outlook for industrials is improving quite a bit. And that is one of the sectors that we think will do well on a go-forward basis.
Well, maybe we can use some individual companies, because I was mentioning yesterday when, everybody was getting excited by what the federal government is sort of getting behind in terms of big projects. There were stocks like Atkins Realis, which saw notable advances. The engineering firm is one that you're watching closely as well.
It is. We've always liked the engineering space. When you look at Atkins Realis, it's the old SNC-Lavalin. If you look at a longer-term chart, they've really struggled. A lot of it was self-inflicted. They have, political scandals, as well as just a really poor performance with their construction business. They've walked away from the construction business, so it's become a pure engineering firm. It's finally broken out above 60, which was a long-term kind of resistance for the stock. It's a much higher quality company. They've got really good organic growth in their pipeline. They have a really strong nuclear division, which really differentiates it from other engineering names. And so we really like that part of the business. We think that will give it a better organic growth profile over the next few years versus its peers. And it's still trading at a discount to its peers. So we think we have a much better quality company that still has some room to re-rate here as that organic growth rate really starts to flow through. As well, we're starting to generate a lot of cash flow, which is something I hadn't done in a long time. The balance sheet is improving quite a bit, so they can re-enter the M&A field, so they will be able to grow through acquisitions as well. And so overall, we just think this is one of the better stories in that space. And like I said, it's trading at a discount to most of its peers. So we think there's still some value to be had here.
I mean, it is an interesting time in that we have kind of all these big trend stories. AI would be one of them. Big infrastructure projects would be another. Defense is sort of another one that people have talked about endlessly for good reason this year. And that's put a lot of focus on actually a lot of companies that are based here in Canada that do have a global footprint as well. CAE would be a great example of that. That's another name that you've been tracking.
Another name we've been tracking, another name that has done okay, but they've had a few things that have kind of been headwinds to it. One, it's defense segment. It's a big part of their business. Over the last 10 years, they've grown it quite a bit, but the margin profile has been deteriorating over that 10-year period. So the company finally has, I think, that business on a track to expand margins. We've seen that turn around over the last 3 quarters, and they've really been weeding out and getting rid of some of their contracts or larger contracts that were lower quality, lower margin contracts, and they're basically replacing that with much higher quality, higher margin type contracts. So we're starting to see the margins improve in that sector, which will be a big tailwind for the company per se. And then on the civil side, they've done pretty well on that side. They've grown it quite a bit. But one of the issues that one of the pushback that I think the investment community had was that the return on investments weren't as great as they could have been. They've been stretching out the balance sheet a little bit. So this new management team coming in, we're actually quite excited how they're viewing things. They will basically really have a much stronger focus on that return on investment capital and on generating cash flow. They will sweat the assets a lot more. So we think there's a real strong possibility of seeing the utilization rates go a lot higher than what we've seen in the past. And there's a lot of operating leverage in that business. So as the utilization rates really improve quite a bit, we should see much better margins on the civil simulation side. That part of the business as well, just the long-term demand outlook for that are phenomenal. The OEM, so your Airbus and Boeing have significant backlogs. And we expect to see deliveries of planes pick up. So that will be another real good tailwind for that civil aviation part of the business.
Just a final question for people who've been watching gold stocks but not necessarily invested in gold stocks. I mean, the move has come so fast that I think a lot of people are trying to figure out, same way, tech stocks have had this big run. What should I be considering if I'm looking at names in the materials sector? Are there stocks within that group that still look attractive to you after the gains we've already seen in a lot of names this year?
Yeah, so we've seen a lot of momentum in gold. So just about any name you could have picked has done fairly well. Having said that, when we look at that space, we still like the underlying demand drivers behind gold. So there's still a lot of geopolitical risk. If anything, we think things are getting a little worse from that perspective. On the fiscal front as well, things are deteriorating. Governments are spending a lot more. So we think that backdrop is fairly positive for gold. The industry itself is much better shape. They're generating a lot more cash flow and returning cash flow to investors. But from that perspective, we still really focus on the companies that have stronger balance sheets, that have lower jurisdiction risk. So we want producing assets that are in good geographies. And we're looking for companies that have good growth profiles. So if the commodity itself, the price doesn't move much, we still want to have some catalysts in those names that will provide some good returns. And a good example of that would be Alamos Gold. They have 3 assets, 2 of them in Canada, 1 of them in Mexico. They've got a really strong balance sheet and they have a good growth profile, looking to grow their production by about 25% over 3 years. So that's the type of story we would look within the gold sphere.
And, one thing I've heard with Alamos in particular, just in terms of the jurisdictions, if we're going to dig deeper into, you mentioned where they operate, but I guess sometimes it's where you don't operate, which is I imagine, a bit of a consideration for investors.
It is for sure, especially from an operating standpoint, the operating assets. When you're looking just for new sites and so forth, that we don't mind taking on a little more risk from a jurisdiction standpoint because the companies are spending money and the governments are usually very favorable to that. But once you start drawing money from those assets, that's where the jurisdiction risk becomes much greater, and we really try and minimize that because that could really that can really change the profile of a story very quickly.
Okay. Dennis, appreciate your time today. Good to get some perspective on a few different sector investing ideas. Denis Taillefer is portfolio manager with Caldwell Investment Management.